In this episode, we're going to talk about how to get money out of your RRSP tax-free.
Welcome everyone. Thanks for tuning in to today's episode. Recently we've been doing some planning work with a high net worth client of ours. They have significant investment savings and safety nets, and they have a sizable RRSP, and they really don't want to take money out of it because
Shocker.
They don't want to pay tax.
They don't want to pay tax.
So today we're talking about a strategy where you can take money out of your RRSP in a tax neutral fashion.
Yeah, we'll put a caveat on this. There is no legitimate way to get money out of a RRSP tax-free, but what we can do is put a strategy in place to offset that tax and therefore making it a tax-neutral transaction. But there's no secret sauce here. We're just putting together some what we would call some smart planning maneuvers.
So the strategy is called the RRSP meltdown strategy, where you're pulling money out of your RRSP, but also utilizing a home equity line of credit, so borrowing money to invest. Tell us a little bit more about the strategy.
Yeah, so I'm going to be upfront completely because this strategy, I would say, is, although it's a good strategy and it works, it's not for everybody.
No.
It's got a few moving parts with it, and it also requires a great deal of discipline from the investor themselves, and a great deal of tolerance for potential volatility.
Emotional stability.
Exactly. I mean, not to say that anybody who doesn't like volatility is emotionally unstable, but it does require that amount of discipline so that if you go through a really bad market, you're going to stick with the strategy. So I'm just upfront about that because I'm upfront with all of our clients before we talk about this. But essentially what the strategy involves is this is really good for somebody who doesn't have any debts as well, or very low debts. Like they've got a house perhaps that they've paid off or very close to paying off, and they can use a home equity line of credit, or a HELOC is the acronym that we use, and you can use that to borrow to invest. Okay. Now the reason why we would borrow out money to invest is because when we borrow to invest, you borrow to earn an income. CRA allows you to write off the interest payments, so you get an income tax deduction for that amount. So let's just put this into some basic numbers here.
Yep.
Let's say you've got a house that's worth just over $120,000 or around $120,000. What CRA is going to do is, what the lenders are allowed to do is lend you up to 80% loan to value. So just for the sake of it, let's say they're going to allow you to borrow out $100,000. I'm using simple math, obviously. $100,000 that you can take out and you borrow out to invest in an investment account that's going to earn income, either whether that's dividend income, interest income, whatever it is, it's going to earn an income. Okay. They're going to allow you to write off that interest rate. Right now, it's generally prime plus a half. So you're looking at 3.95 prime plus 0.5%, which as of today's date, that's what it would be. You're looking at 4.45% per year, or $4,400 roughly in an income tax deduction that will produce for you. Now, there is an interest cost of $4,400 roughly per year because you still have to pay that. But if you have an investment account at $100,000 that's generating at least $4,400 a year in growth plus interest plus dividends, whatever it is, it can pay that for you basically. Okay, so I would take that as a completely neutral strategy. You're not making money on it, you're just breaking even basically. The kicker is you're getting that income tax deduction for $4,400 per year, meaning that you could trigger taxable income of $4,400 per year in another vehicle, such as your RRSPs. It would allow you to essentially draw out $4,400 per year without paying taxes on it because you're getting an equal write-off from another area. Okay, so you're still paying taxes on the money coming out of the RRSP. All we've done is we've created an income tax deduction in another place where you wouldn't have had it otherwise, and essentially you're balancing out to a tax-neutral situation there.
Okay, so let's get this straight for the viewers. If I take out a loan, do my home equity line of credit or my HELOC of $100,000, and for math purposes, let's say I'm paying 4.4%.
Right.
That means I have a $4,400 interest expense that I can write off.
Correct.
Against $4,400 of income coming out of my RRSP, neutralizing the tax on that RRSP money.
You got it. Yeah, absolutely. Now I'm simplifying this down because in that investment account, we've also created growth, which would be taxable as well. So there is some tax on that. So there is some math work to be done here. But let's just forget about that for now, because that can be worked out in the math. But essentially, you're right. What we're doing is we're creating an income tax deduction of $4,400, allowing us to trigger $4,400 of income tax somewhere else that we can use it to write off against.
Great. I think that's it for this episode. If you have questions about the RSP meltdown strategy and you think it might be something that fits with your personality and your portfolio, we'd be happy to chat further. You can always visit us at www.whitehoustonwealth.com. Send us questions, emails to whitehoustonwealth@mbc.ca. We're always happy to touch upon a topic that our viewers are interested in.
Like I said, there's a few moving parts with this one, so happy to talk anytime if you want to get more details. With that, ready,
Aim,
fire.